So welcome back. Today we're continuing financial assets. However, we'll be looking at our accounts receivables question for today. So let's go right into it. So our question says, which company completed the following selected transactions during 2007 and 2008? So here we are seeing the transactions that we have, right? And we have them from 2007 to 2008. Then we go to our required. Let's look at that. So the first requirement says A, we're supposed to open the general ledger accounts for allowance for uncollectible accounts and the uncollectible accounts expense. Keep running balances, right? And we'll see what that means. All accounts begin with zero balance. B, record the transactions in the general journal and post to the two ledger accounts. So the two ledger accounts that we're talking about is from A, the allowance account and the uncollectible expense account. So A and B, we'll be seeing where we'll be doing those together. C says on December 31st, 2008, balance of accounts, right? The balance of accounts receivable was $139,000. Show how the accounts receivables would be reported on the balance sheet as at that date, right? So let's go right into it. Remember what we're doing. We're still looking at financial assets and we're accounting for accounts receivable. You can go and check our prior video where we went a little in depth and we expounded and we explained on how to account for our accounts receivables. You know, we have the two methods, which is the more preferred method, and how we go about doing that whenever we have bad debt or when we previously recorded a debt and then it was recovered. So you'll see all about that. Before, we would have looked at what our accounts receivable was and what financial assets are, and that is what you're seeing here. So accounts receivable is another financial asset such as like cash and or marketable receivables. So the first thing that we'll be doing, it says to open the ledger accounts, right? And the ledger accounts that we'll be doing is allowance for uncollectible accounts or allowance for bad debts or allowance for doubtful debts and the expense. It says all accounts begin with zero balance, and that is what you're seeing here on the screen, the allowance account, and you're seeing January 1, 2007, because remember, we have two dates, we're running in 2 years, and the balance is zero. The next account is the expense account, and we could have here done the zero balance, but remember our expenses at the end of each period is closed out to our income summary account. So here we need not have a balance or allowance of bad debt, and you will see it's not an expense account. So therefore it's not like the expense that is closed out to your income summary. This goes to your balance sheet, right? Then what we're doing journal. So we're doing all the headings, and this is our heading, as we know, for general journal where we have the date. Again, we're starting in the year 2007. Then we have the accounts and the explanation column. We have post-ref that we won't necessarily be using here. Then we have our debit and our credit column, because to journalize, we know we have to debit something and to credit something. So let's recap. Remember, we're doing the allowance method. And how do we know that we're doing the allowance method? Remember, looking the question, we're doing the allowance for uncollectible accounts. So if we're making a provision, if we're making an allowance, we must be doing the allowance method. And you'll see further in the question where it tells you to use the allowance method, but just from the requirements. So here, when you're doing a question, it's learning to decipher what is being asked of us by reading the requirements or even looking in the question for key terms. So we're doing the allowance method. So let's recap what the allowance method includes. One, we have to do an estimate, right? We have to estimate the uncollectible accounts at the end of the accounting period. Then we make the adjusting journal entry. One, to recognize the bad debt expense, and two, either to create or update the allowance account. In this case, we're actually creating an allowance. We're not updating it because we don't have any prior information. It says all accounts had what? Zero balance. So there's nothing to update, but we're creating it. And by doing that, we debit or allowance or expense account and credit or allowance. Hence why our allowance had a credit balance. Then, after we've done this, if there's no debt that went bad throughout the year, then what we do, we close the expense account and we close it out to the income summary. Then we put the allowance for doubtful debt that is shown in our balance sheet as a deduction from the receivables. And this is the extract here. And I'll fast forward. This is what part C is asking us for, to show what it will look like in the balance sheet. The note here, it says when a debt is identifier goes bad, that is, the account is deemed to be uncollected, which is the asset account. The asset account is not useful and should be written off. And this we're saying is what happens when somebody now cannot afford to pay you. You have made that provision, yes, but now is the real time. They really can't pay you. Either you've been calling them for months and months and not getting them, or they send you a letter saying, oh, we're bankrupt and we're so sorry, but this is the case. When that is the case, what we say we do is that we pull from the allowance account, and we pull from the allowance by debiting the allowance account and crediting the receivable to reduce the amount, right? So that's just a recap of the allowance method steps. So let's get into the question. So it says on December 31st, and we're in 2007. The estimated uncollected account bad debt expense for the year was 1% of credit sales, and credit sales was 400,000. This was recorded the amount as an expense. We're supposed to record the amount as an expense using the allowance method. And here again is where I'm telling you the question told you what method to use. So looking back at the steps, we are supposed to what? Estimate the uncollectible for the end of the period. And the end of this period, we're at December 31st, right? Sorry, going ahead. And how are we going to estimate? It said that the estimate for the year should be 1% of sales. And remember, again, check our prior video. How do we make this estimate? How can we make it? We can do it what? Either as a percentage of sales or by the aging of the accounts receivable. Here in this case, we're using what? A percentage of sales. So our estimate is going to be 1% of 400,000, and that is what? 4,000. So that's our estimate. So after we've made our estimate, what we need to do, we need to make the adjusting entry to recognize this estimate, this provision as an expense. And no, because we're just doing this to create the allowance account. And how we do that is by debiting the bad debt expense and crediting the allowance. So that's our first journal entry. And what does this look like in the expense account? So remember, we debited the expense. So on the debit side of the expense, it should be seeing it December 31st, 2007 adjustments, or you could have allowance 4,000. And what does this look like in the allowance account? Remember, we're debiting the expense, crediting the allowance. So December 31st, 2007, on the credit side, bad debt expense, $4,000. Remember in the question, what did it say to us? It said to keep running balances, right? And simply what running balances mean is at the end of each transaction, you need to know what's the balance PD. So here, if you would look at our prior video, and I think suspense, how we closed off an account and we found the difference between the two sides and put in the CD and then carrying the balance BD on the opposite side, that's what we did here. but we didn't show all the steps, right? It was just done. And just by looking at this, you can know that, okay, the balance is going to be on the credit side because the credit side has the more amount, right? Because nothing was on the debit side. So the running balance here is a credit balance of 4,000. So we would have made the estimate, did the adjusting entry. There was nothing in 2007 that spoke about us pulling from the provision. So we go to point 3, which is what? To close the expense income summary, right? And to show the doubtful debt in the balance sheet. But we won't be doing that part, and I'll further explain. So we're going to be closing, the expense to the income summary. And how do we do that? So remember, once we have an expense, it is normally debited, right? Once an expense is incurred, the expense is debited. To close it, remember again, go back to our suspense video where you see how we close out an account and you see all the steps. So here, we're not closing it out to show the balance BD and the balance CD. No. If you remember our accounting cycle, our financial accounting cycle, where we record the transaction, we journalize, and we put to the ledger, then we go to our unadjusted trial balance, we do our adjustments, then we have our adjusted trial balance, then we do our final statement or our final accounts. From our final accounts, we then do our post-closing entry and our post-closing trial balance, right? There is where we close out. In doing our post-closing entry, we close out all our expenses. We close our revenue accounts and we close out our expenses to our income summary account. So this is what we're doing. To close it to the income summary, remember our bad debt was previously debited, or expenses, my bad, or a bad debt expense, same thing, it was previously debited. So to close it out, what side would we now have the lesser amount? We would have the lesser amount on the credit side. So we now know we need to credit it. Again, I encourage you and I implore you, go back to our suspense video and see the steps. But remember, this is the expense account that we're looking at. It had the debit here, nothing was on the credit side. So to close it out, we credit the expense account and we're closing it out to our income summary account. So that's why we're debiting income summary and crediting the bad debt expense. So this is what it looks like in our bad debt expense. So this account is now closed. Inevitably, we would have answered the second transaction for December, which was to make the closing entry for the uncollectible account expense. Because of the step, if we remember the step, we will always do this at the end of the year. So let's continue. On January 17, we sold inventory to Mitch for $600 on account, and ignore cost of goods sold. So we sold goods. What's the entry for that? 1, we sold it what? On account. So this is what? On credit. This is now Mitch Vance is now an accounts receivable. Accounts receivable is what? An asset. So when that increases, we would debit the accounts receivable. And we sold it, so we would have earned revenue. So we would have earned sales revenue, and we credit sales revenue when it increases. So the entry here is the debit accounts receivable, Mitch Vanez, and to credit our sales revenue. This alone here has nothing to do with our bad debt expense. So this entry is just this entry. Let's continue. On June 29, we wrote off Mitch Vanez's account as uncollectible after repeated effort to collect from him. So what this is saying, you sold him on January 17, 6 months after, right? You're trying to collect the money from him to no avail. He's not answering you. You're not getting any money. And you're saying, it doesn't make sense for my business to have this amount as a receivable on my books, in my balance sheet, right? Claiming that this is an asset that I am going to get, right? That is not fair and true from your point of view at this point in time because you've been trying to collect that money. So you don't want to deceive your investors and your partners. So you're saying, okay, I'm not getting this money from him after 6 months, and I might have told him that you need to pay me by 1 month. That has gone 5 times, right? So what you're saying, okay, I would have already made a provision. So I'm just going to write this off and call it a loss. How do we write this off? Using the allowance method. How we do that is to what? Pull from the allowance of bad debt, and how we pull from it, we debit it, right? Because to make it, to create it, we credited. So to take from it, we have to debit, right? So we're debiting the allowance 600 because that's the amount that he owed us, and that's the amount that we're writing off. And then we're crediting the receivables to reduce the receivables, to say this is not our total receivables, right? This is not true. So how does this look on our allowance? So it's a debit 600. And remember, we're keeping a running balance. So the balance here, the new balance in our allowance, is that still a credit balance, but this time of 3,400. Let's continue. So we're at August 6th. So August 6th, whoa, we received the $600 from Mitch, along with a letter apologizing for being so late. And this is normal, this can happen, right? And that is why we know how, and that is why in our previous video, we said what we said, what happened when, because here it was a good decision to write it off because more than 6 months has passed and you have not heard from Mitch, right? And you wrote it off, but within almost another month's time. So this would have been 7 months. He said, all right, he's apologizing. He wrote you a letter and he's making the payments. So what we have to do, we have to reinstate his account in full and record the receipt of cash. And how do we say we go about doing that? So first, what we have to do, we have to reinstate, to reverse the write-off that we did. And to reverse the write-off that we did, let's look at what that looks like. So we're going back on the steps. What happens when you receive payment for a debt that you have wrote off? So in parts 1 and 2, steps 1 and 2, when we made the provision, we debited the expense, credited the allowance. Then when we pulled from it, when we are going to write off a debt, we debited the allowance, credited the accounts receivable. So now when we've gotten back payment, we have to reinstate the account. And all that is reversing the entry that we did to write it off. What was the entry that we did to write it off? We debited the allowance and credited the accounts receivable. So to reverse that, to bring back the account to its rightful stage of Mitch owing you, you have to reverse this. So to reverse this, you have to what? You had debited allowance, so to reverse it, you have to credit allowance. And you would have credited accounts receivable, so to reverse it, you have to debit accounts receivable. So that's the first entry in this case. But remember, he paid you. So because he paid you, you now have to record the collection of cash, the collection of payment. And that is simple. Somebody that owed you paid you cash. What's the entry for that? Debit cash, credit accounts receivable, right? The customer account. So that's what we're doing here for Mitch. So the first part we're doing, we're reinstating the accounts by we're increasing back the accounts receivable to say Mitch owes us this 600, and we're putting back this money in our allowance. So here in our allowance, this is what it looks like, the credit of the 600, putting back the money and a running balance. So now we're back to our balance of 4,000, right? So the next part after we've reinstated is to record the payment of cash. And the payments of cash, we're debiting cash, crediting accounts receivable. That's the entry there. So let's go to December 31 now. So we made a compound entry. And what do we say a compound entry is, right? In our previous slides, we would have touched this. So a compound entry is what? Putting two single entries, two single debits and credits together into one transaction because they would have had some similar entry before. So here we're doing what? Accounting for receivables and bad debts and uncollectibles. So we're just going to make the assumption that here the uncollectible would be the similar transaction in both. So we're making a compound entry to write off the following accounts as uncollectible and we set it. So this is two receivables that we're saying, okay, we're not going to get them. And how do we do that? Remember, we pull from the provision, which is the allowance, this amount, and then we credit the accounts receivable. Here it said it was Bernard 1,700 and Marie 1,300. So because we're doing a single compound entry, the sum is what will go to our accounts receivable. And this would be the same because if we were supposed to do them single-handedly, we would have debit allowance 1,700 for Bernard and credited accounts receivables Bernard 1,700 and would have done the same for Marie. So we're putting those in one entry, right? So, and this is what it looks like in our allowance accounts. A debit, accounts receivable, and you have both 17 and 13. Remember, we're keeping a running balance. So here, no, we have a credit balance of 1,000 because we would have taken out 3,000 from it. So we're still at the end, December 31st. We now make what? A new estimate for the year. And we're saying this time our estimate is 1% of credit sales. And our credit sales is what? 480,000. So we need to record this amount and expense it. So 1% of $480,000 is 4,800. So what's the entry? This time we're not creating the allowance, but updating. And whether we're creating or updating, the entry is the same. The entry is to debit the bad debt expense and to credit the allowance. What does this look like in the bad debt? On the debit side, 4,800. What does this look like in the allowance? On the credit side, 4,800. Again, we're keeping what? A running balance. So now our balance is 5,800 because we updated it 4,800 and we had a balance of 1,000 prior. Then we're going to make the closing entry for the uncollectible expense. So we're closing the bad debt expense account. How do we close that? Remember how we did it prior. What did we do? We debited the income summary, right? And we credited the bad debt expense. This is what it looks like in our bad debt expense account. So now we would have finished all the transaction here. So we would have done A and B because we would have opened the ledgers, we would have journalized, and we would have posted to the ledgers. So here it says C on December 31st, 2008. So after all this, the balance for accounts receivable is 139,000. So what we're supposed to do is we're supposed to show how accounts receivable should be reported in our balance sheet as at December 31st, 2008. So remember, after we would have closed out income summary, right? We're at this stage showing the allowance, putting it in our balance sheet and deducting it from our receivables. So what we're going to do is a balance sheet extract because we're only showing we're only zooming in on a particular line item in our balance sheet. So our balance sheet would have had cash and everything, and this is just to show that it would have had other stuff. Then you have your accounts receivable. We're using or in a column this time because we have some working out to do. So from this accounts receivable, we're lessing the allowance for uncollectible accounts. From it, then we would get to our net receivables figure. So this is our balance sheet extract, and we're starting with our heading. So it's what is company, what we're doing, the balance sheet extract. This is not the full balance sheet. So we can't just have balance sheet and just be showing the receivables part. That is not a balance sheet. And again, the date that we're doing it for, December 31st, 2008. So we have our accounts receivable, and it told us in the question, it is 139,000. We're supposed to less the allowance for doubtful debt. And where is this coming from? So remember your allowance account. What was your ending balance at the end of December 31st, 2008? So the ending balance on one period is the beginning for the next, right? So your balance here is 5,800. And this amount is what we'll be carrying for the balance sheet extract to deduct from our accounts receivables figure. And there, after subtraction, we'd have gotten our net receivables figure. So this is what your balance sheet extract should look like, should show what your accounts receivables should be reported as 132,000, because we made a provision and we're saying, okay, this is what we're estimating that we won't be collected. So the true value of our accounts receivable should be about 133,200. So that's the end of our question for today. If you have any questions, remember, you can share with us. You can always send us an email at grandmajorsacademic@gmail.com. Send us a DM at grandmajors on Instagram. Remember to like this video, share, subscribe, leave a comment, query, or just a feedback in our comment section. So I'll see you next time for another video.